So, topic for today, sir, the elephant in the room, the one everybody's talking about, the conflict with Iran. And what we want to talk about specifically is its effect on the economy, on prices, and of course on investments.
Yeah. So as Damon mentioned, it's really the main focus today is around the Strait of Hormuz and how that's affecting the economy. I'm not sure we're the best to talk about the humanitarian side of it, but it's an important topic that everybody obviously is paying attention to. But we'll keep our focus specifically around the Strait of Hormuz and the impact on, as Damon mentioned, the economy, markets, and pricing. So maybe start with some of the stats around that.
Yeah. Oil goes into thousands of consumer products. And if you include the transportation costs to get it from producer to market, oil affects almost everything.
Oh, actually, 6,000 plus consumer goods.
Right. It has a tremendous impact on the economy. And the Strait of Hormuz, what travels through the Strait of Hormuz normally, not now, but what normally travels through is about 20 to 21 million barrels per day of oil. That represents somewhere between 20 and 25% of all seaborne oil in the world. It also represents about 20% of the liquefied natural gas, or LNG, that travels by ship around the planet. And the important thing is that about 80% of that goes to Asian markets. That would be China, India, South Korea, Japan, Malaysia, Australia, those kind of places. And so when you essentially cut that off, or largely cut it off, effectively cut it off, you kind of get what we've had, which is the price of oil has now, in the span of roughly a month, not even a month, gone from about $60 a barrel, $65 a barrel, up to $120 briefly on March 8th. And it's pulled back now down into the $98, $99, $100 a barrel oil.
Yep.
So we have here in the U.S., it's important to point out, the U.S., we take almost nothing from the Strait of Hormuz, right? As I said, most of that oil is going eastward. It's going towards Asia. Here in the U.S., we're not really affected by that. We have plenty of oil here in the U.S. to meet our needs. So why does that matter to us? Well, I don't know. Why is gasoline up nearly $1 a gallon over the last month? Well, the answer is pretty simple. It's an economic principle, actually. So put my economist hat on real quick. There's a concept called prices are set at the margin. And what that means is, in so many words, is the highest price that anyone is willing to pay for that barrel of oil becomes the price that everyone pays for that barrel of oil. That's what they mean by it's set at the margins. And that's why, even though the oil coming through the Strait of Hormuz isn't coming to us, it has every bit the effect on oil prices for us as it would for places like Asia.
And that's probably because other economies, other countries are willing to buy the oil from the United States, and anybody producing oil is willing to sell to the highest bidder.
Yeah.
To Damon's point.
Yeah, correct. Exactly. And that's how it affects us here. You say, wait a minute, how can oil that we're not using cause such a big jump in our gas prices? That's how. It's the concept of setting it at the margin. So let's move into a little bit about the stock market. As we sit here, we're down just a little bit over 7% on the S&P from the all-time high to today, to just a few minutes ago when we checked it, actually. Could we talk a little bit about that?
Absolutely. And as Damon mentioned, at the end of January, we were at 7,000 on the S&P. Today, it looks like we're going to close below 6,500 potentially, or right around there. And going back over a couple of years, we've been anticipating a market correction for many months. Nothing to do with a prediction of the Iran conflict, but really just simply on a valuation basis. Typically, markets are trading somewhere between 16 and 19 times forward earnings. As recently as January, they were trading at 24.5 times forward earnings, which is a little bit pricier than normal. So it wouldn't have been surprising to see some shock or some pullback in the stock market. This was hopefully not going to be the reason why, but nonetheless, it turned out to be a good excuse for the markets to pull back. So what are we doing here as advisors in the meantime? we're noticing and we're trying to take notes of the things that we can control. And some of those things include looking at what areas of the market are becoming more reasonably priced. And there are many areas of the market that are now becoming reasonably priced just in the last few weeks. We're recognizing that underlying growth, at least for now, remains solid, and there are pockets of strength. Some of those include technology, energy, obviously with the price of oil and energy up, any energy producer is now in a position to profit from that. Materials and also even corporate CapEx spending or capital expenditure spending has remained solid at the very least. One of the examples of this, a great example we've been talking about for many years, NVIDIA has been one of the bellwethers in the market. They produce semiconductor chips that go in all manner of goods, particularly around AI infrastructure, data center. They're used for large language model training and learning, agentic AI. NVIDIA had been trading as early as January at 35 times forward earnings. A couple of years ago, 2023, it was trading over 100 times forward earnings. Because of the conflict that's going on now in Iran and the Middle East, in the meantime, earnings for NVIDIA have continued to climb while the prices remain steady and even dropped a little bit, making the current forward price to earnings multiple having dropped all the way to 19 times. So a much more reasonable price point. And it might even be lower than that now that we're watching markets fall here today as well.
Right.
So it is becoming, we're looking for opportunities in the midst of what's happening. Long term, AI will produce enormous productivity gains. That's one thing we can be certain of. One of the ways that you measure productivity is the amount of goods and services that are produced divided by the number of people it takes to produce said goods and services. And so if you think about with productivity and goods and services being able to be produced at 1.5, 2 times, and maybe 3x what they were previously, without adding additional people to that equation, productivity gains are strong, and that tends to flow back to bottom line, which increases earnings over time. So when you look beyond the Iran conflict, and we're not trying to predict the timing of this conflict's end, but when you look beyond the immediate scope of time, for long-term investors, we do still see a good reason to want to be positioned in markets, but we want to be cautious at the current time. So let's give you some takeaways from today.
Let's do some takeaways.
Yeah. And I'd say a couple of the ones that are really important. One, markets always turn before the conclusion of a conflict or before the conclusion of an event.
You bet.
So it's really important, always a tenet that we've talked about. You don't want to overly try to time markets. Now, it's different if you're adding new money for investments or if you're looking to take money out. You might want to be a little bit thoughtful and cautious around the timing. But in general, you don't want to try to say, let's sell everything or let's buy all at once. That typically leads to poor timing and poor pricing.
Right.
It's also, this is an excellent reason that you'd want to remain broadly diversified. Because it's again, the age-old problem, we still can't predict the future.
This shock is going to affect different industries and different companies in very different ways.
Absolutely. And I would also expect volatility to continue. Uncertainty has been a tenor of the past few months. I would expect that to continue for the coming few months. Again, so what are we trying to do for you and all of our clients? We're focused on trying to find opportunities during this conflict that makes sense. Some of the ones we've highlighted, of course, in technology, energy, materials, but also we're looking at sectors like banking and healthcare, where we know that AI will ultimately find ways to make those sectors more profitable, less costly for consumers, or create better services. So while we can't control events that are happening in the world, we are laser focused on making sure that we're looking for opportunities for you and on all of our investors in the meantime. So thanks for joining us. Thanks for listening in a little bit. And please do contact us if you have any questions.
Thank you.